Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. When the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. It is Thursday, so we got Philadelphia Manufacturing Index and jobless claims today. And, well, you know, we probably could have taken some trades yesterday. I kind of regret not doing so, but I didn't really see anything to auction. It ended up being a big deal. But today, you know, we might have some news. Tomorrow, we got like a lot of gamma expire. So I think the S&P 500 might be a little bit constrained here. So let's just go to the charts and kind of take an inventory of things. A few things to point out if I can even freaking find. Oh, here it is, daily. I was looking at the daily charts. I was like, look at how far away from any kind of level moving average we are. Okay. In the S&P 500, so you can see yesterday, they kind of made the move up towards 4,700 and then kind of fizzled. Here we are again. I think we may continue to see some of that action in the S&P 500. Like, we're extremely likely to settle somewhere above 4,700 for Friday, okay? Because of options. Here in the 10-year, they had a pretty good move up, but a pretty lackluster trade in the overnight here. But again, we do have some news. Might push us back down, okay? Oil taking a hit yesterday. There is talk about releasing strategic reserves now. Apparently, they have already been releasing oil from the strategic reserve because of some law, is my understanding. If any of you guys trade oil, understand more about that, about how they've already been releasing stuff from the SPR, I would love to know what that's all about. But there was a law that mandated a certain amount get sold out. So I don't know what the deal is with that. Natural gas calmed back down and is around 4.9. All right. Gold and silver. Well, they recovered a little bit of the losses from the previous day, and now in the overnight, they're going down a little bit. It's a little curious because the interest rates and so forth aren't really moving. I wonder if maybe there's less concern over inflation now. By the way, read an excellent analysis from the Chicago Fed about what moves gold, and basically showing that you, even with the rising interest rates, that you can still buy gold and make money. But anyways, the dollar continues to be fairly strong, above 95.7, and Bitcoin still kind of having some. Well, sorry, we got to move the things over, but Bitcoin's still kind of having some issues, having chopped around over here for a couple of days, and now dropping below 60,000 and its 50-day moving average. Okay. I heard this morning on Bloomberg that President Biden asked China to release oil. Yeah, I'd have to look at that. He has been asking everybody. Like, that's the thing that's kind of wild about this, is that he went in and he made a bunch of policies that really kind of hampered the U.S. production, and then he also pissed the Saudis off, and then went around and complained about how everybody else needs to put more oil out. So it's really Joe Biden's fault, but I mean, are the Saudis really our friends? I don't know. Okay, so here we're going to be getting the news here. So more interested in that Philly Fed. We're looking for a reading of 24. Okay, so we got 39. Oh, geez. Too bad I don't have any volume out there. Would love to buy it. I mean, this right here. And the continuous jobless claims 2.08 versus a 2.12. So Okay, I guess it's not going to do that. Okay. I'm going to see if I can work out a position here. Let's see, anything else moving here? I mean, gold is moving down, but it was kind of already that way, so... Good. These two are a little questionable, so I'll just hold those out. Nope. This might go without me because I can't take a trade over here in that with that spread. No, sir. They're like, where'd you go, Seth? Where'd you go? I'm right there. I'm right there. Ain't nobody gonna hit that. We did get a decent amount of selling in the 10-year off of this news. You wouldn't. I'm actually surprised how big the change was there, because there was about 16 to 11, so it was about 5,000 contracts down. I guess the overnight action being really, really calm is kind of having an impact there too. How can we learn of market events and potential impact? You mentioned being informed, but how do you find out about that events and how it will have an effect? Okay, so have you read the inelastic markets hypothesis paper that I mentioned? I mentioned that yesterday when you asked about it, yeah? Hold on a second. We'll open it up here and I'll show you. I mean, a lot of it is experience, right? But so they were kind of giving me this look like, you sure you want to do that? And like nobody was going to fill me over in here. Now they're kind of going. Okay, you haven't read it. So here's the first thing is try and find studies. So like you could go to ssrn.com. XRIV is, what is it? What is that one called? What is it? arxiv.org, which is run by Cornell University. And they have all of the different categories of scientific journals, and there is quantitative finance. I feel left out. I think if I wanted to trade that one, I should have gotten in before the news. It's okay. I also shouldn't have gotten rid of both of my contracts, but that's okay too. So I think that I'm going to have to wait here. Okay, so here is a paper. In Search of the Origins of Financial Fluctuations, the Inelastic Markets Hypothesis by Xavier Gabiax and Ralph S.J. Koijen, June 2021. Okay, so this is recent. And I personally believe that this is the most significant research to come out in of the decade or of the next 10 years. Okay. We develop a framework to hold on. News Squawk is saying something. So it's Canadian numbers came out here. We develop a framework to theoretically and empirically analyze the fluctuations of the aggregate stock market. Households allocate capital to institutions which are fairly constrained, for example, operating with a mandate to maintain a fixed equity share or with moderate scope for variation in response to changing market conditions. AKA, a lot of the moves that large funds make aren't based on the fundamentals, right? They're just based on, I have to maintain a fixed equity share, okay? As a result, the price elasticity of demand of the aggregate stock market is small, and flows in and out of the stock market have large impacts on prices. Okay. What does price elasticity mean? That is how much the supply and demand of something is affected when the price changes. If it's inelastic, that basically means that it doesn't constrain, rising price doesn't constrain the demand for it. In fact, if anything, it could have the opposite effect. Okay. So then they quantify that. Using the recent method of granular instrumental variables, we find that investing $1 in the stock market increases the market's aggregate value by about $5. Put $1 in, it moves the market cap of the market $5. Okay. That's a pretty significant finding, wouldn't you say? Especially when you consider how much money the Federal Reserve has been putting into things and all of that, right? Okay. So they go through this. You can read this and you can see all of the math that they go and do everything to see how they're determining this. But it's the conclusions that they get from this that makes really big importance here, okay? An important takeaway from this paper is that the demand elasticity of the aggregate stock market is a key parameter of interest in asset pricing and macro finance. Just like investors' risk aversion, their elasticity of intertemporal substitution and the micro elasticity of demand. We provide, okay. That wasn't the part that I wanted to read. Oh, here we go. Okay. How tenets of finance change if inelastic markets hypothesis is correct. Permanent price impact must reflect information. That in Proposition 5, a one-time non-mean reverting flow permanently changes price, even if it contains no information whatsoever. This is because a permanent change in the demand for equities must permanently change their equilibrium prices, and this effect is quantitatively important in inelastic markets. The typical empirical strategy to look for reversals as signs of flows rather than information moving price does not work in this case. By the same logic, we can see large changes in prices but small changes in long horizon expected results. Read, just because the market moved and then held that price doesn't mean that there was a change in information or a change in the market's expectations. Okay? Fast and smart investors will provide enough elasticity to the market, and they say this is not true. Trading volume is very high, so the equity market must be elastic. They're also saying this is not true. Okay. For every buyer, there is a seller, so saying there was an increase in demand for equities is meaningless. The economists often appeal to the truism that for every buyer, there is a seller to disregard the notion that a measurable increase in willingness of the average trader to buy more of the market will push prices up, aka buying pressure. Our model clarifies that this reasoning is incorrect. Okay, so they're saying if people come in and buy things, that moves the market up. Okay, that's one of the key things that we kind of go off of here, right? What do we say? Orders move markets. Here's the one. Share buybacks do not affect equity returns, but then they basically say that's not true. Share buybacks very much affect equity returns. And in fact, that's probably a really great thing to look for to make money. Okay. So then in here, and here's the part that you really want to pay attention to, G59, okay? What are the determinants of flows? It is clear that it would be desirable to know more about the determinants of flows at a high frequency. We provided a minimalist model with a behavioral disturbance and some simple correlations in section 4 spot 4, but this is clearly a first pass. Establishing the various channels of flows will be a whole line of inquiry, perhaps with microdata such as those used by Cavadeo and Giglio. Okay. To appreciate the richness of those determinants, let us observe that flow shocks could come from various sources. And then they list the sorts of things that you could look at. Changes in beliefs about future flows or fundamentals, as these both affect expected returns. Liquidity needs, for instance, insurance companies selling stocks after a hurricane. 3. More generally, heterogeneous income or wealth shocks to different groups, including foreign versus domestic investors, changing the effective propensity to invest in stocks by the average investor. Corporate actions by firms, such as decisions to buy back or issue shares. Shocks to substitute assets, which might, for example, prompt investors to rebalance towards stocks when bond yields go down. Pay attention to that one because Bitcoin don't look so hot right now and gold does. Changing in the advertising or advice by institutional advisors. Roadshows in which firms or governments try to convince potential investors to buy into a prospective equity offering or privatization. And then mechanical force trading via delta hedging. And this one is huge. This is probably the single most exploited edge out there in the market today. Mechanical force trading via delta hedging, whereby traders who have sold put options and continuously hedge them need to sell stocks when prices fall. Okay. So you smell what I'm stepping in now? They're asking the question, will this event affect people's propensity to want to buy or sell stocks, right? And then we factor that into their model. So that's what we want to do, is we want to look at the news and the economics and everything that's going on, and we want to ask, does this affect people's propensity to invest? Or over here in the treasuries, we have to ask, are there things that we know right now that are happening that affect people's propensity to buy treasuries, or the firms that buy them, that they're going to buy treasuries or not buy them, right? And then we can go down through that. So yesterday, there was an auction. Does that affect what they do? Yes, it does. And then you kind of have to look at the situation and everything and kind of try and guess what it is that they're going to do based on the available information that you have, right? Today, we just had a piece of news, right? We got the Philly Fed, and was it Philly? I forget now. Yep, it was the Philly Fed Business Index was 39.0 versus 24, and U.S. continued jobless claims was 2.08 versus 2.12. So those were numbers that were different from what the average market expectation was on those numbers. That means that the economy is doing better than expected, and as such, we should expect to see interest rates rise slightly as more people might be willing to sell their treasuries because the economy appears to be going well. Make sense? Does that answer the question? So there could be so many different things that could affect this, right? And then what we would want to do is I mean, if we were really sophisticated, what we would want to do is take that particular thing and then run it into a model to see what kind of an impact it actually has on the aggregate market. But I'm not that sophisticated. But I can just come in and I can just ask myself the question: how does this affect people's trader and investors' propensity to buy or sell treasuries or whatever market it is that I'm looking at? And then I make my decisions based off of that. Because people think that the stock market reflects all currently available information. It doesn't. It's just a record of people buying and selling, right? It's not a new question, G59. What it is. Don't apologize for that. You asked the question that every trader should be asking and doesn't ask. That's the thing that's so wild about it, right? Is like it doesn't it kind of feel like, all of a sudden you can see the matrix. There's all of these contradictions and people have all of these different opinions about why markets move the way that they do, and all of these people have all this technical analysis and they got these lines and everything, and they say that means that the market thinks this and the market thinks this, and these guys with one fell swoop completely destroy all of that, right? It's basically like, now price is inelastic, like the price doesn't matter, right? Because the rise in price or not doesn't really affect people. It's really, do people want to buy or sell? And people wanting to buy and sell has such a big impact that it basically overwhelms everything else, right? And now all of a sudden there's this whole world of trading that you basically is empirically shown to be nonsense. And then there's this whole other world of empirical research in trading that is all of a sudden open to you. Because I tell you what, you can come over to like Zero Hedge. Oh man, I would have to go back several days to find it. But Zero Hedge will post articles about this sort of a stuff. For instance, Goldman Sachs has analysts that talk about flows. And they go through and they use models to try and predict how much money is going to come into the markets over the next 2 to 3 months. So Goldman Sachs is like quadrupled down on a call that stocks are going to continue rising into the end of the year, when a lot of other people are saying that we're going to have a drop. But they've gone and they've done the homework and they've shown that people's propensity to invest is still quite high, and they've been able to quantify how much money they think is going to come in. So if we were going to, just take like a swing trade here for a few months, we would want to be along the S&P 500, right? And that might matter because another one that we got is gamma, right? So there's a lot of gamma on at 4,700 in the S&P 500, and there is a lot of gamma on in the Treasury. which could constrain Treasury movement today and tomorrow, but on Monday could lead to an increase in volatility. So what we might get, based on the option that is rolling off, we might get equities selling and treasuries buying on Monday. So we're going to be stocking that on Monday, right? It's just, I think it changes everything, you know? And this is why you notice I'm always giving people shit on stream. Because they'll say things that are, in my view, contradictory to what we just learned, right? Well, it's still possible that the treasuries move here, but I would have to say that the movement right now is pretty lackluster. Like, we got some good selling. We did get selling. It's not really going very far. I didn't see big icebergs down in here, so I don't think that would be congruent with people, large buyers wanting to continue yesterday's move. Doesn't mean that we won't have a move down here, because I do kind of see that some of this liquidity is flighty. We're not putting 3,000s up yet, so there you go. That's kind of where I've been recently in regards to shifting from the TA side of trading to actual science-based trading. Yeah, man. So there's some people on TikTok, and I don't know how much of I know that one of them, he was watching a couple of my videos, but I don't think that he was convinced. He was pushing TA. It's really funny because Bitcoin has taken a pretty big drop, right? It was you don't realize it because we're only where we were in Bitcoin like 2 weeks ago, right? I mean, people point that out, but I want to point out it was a 10% drop. Like, a lot of money came out of the market there for that to happen. Okay. What we know about the markets are inelastic. For them to have moved that much, there's a decent, relatively significant amount of money that came out of the market. Oh, there you go. Then now they're back to the lows with hardly any volume trying to push against them. And there's the 6th spot too. I really wish that I had gotten 61, but they never really were putting volume into it. So I still have my sim trade on, I guess. Anyways, so they have this big drop, and now all of the technical analysts that didn't see that coming, by the way, are all trying to justify it as, it's just a blip and all this sort of thing. And they're like, technical analysis is both a science and an art. And I'm like, no, it's not a science at all, because almost all of the data that you can procure says that technical analysis doesn't work. In fairness to the people on the technical analysis side, there was work done, like in the 70s. I really, like when what is it? Not Bollinger. Well, the guy that invented Bollinger Bands, but what was his name? Wilder. When Wilder came out, you kind of started to have the ability to look at this stuff quantitatively, and you had some information that kind of made it look like it was promising. And there are some studies that you can go and find out in the research that kind of suggests that, oh, hey, if we use this moving average or whatever the deal is, we get profitable results. But then what they later found, and what you have to consider whenever you read a study like that, is that they didn't think about the bias, like the curve fitting biases, right? I forget what the other word that we use for it. Man, my brain is not really on today in terms of like recalling things from memory, is it? Selection bias. There you go. They don't really consider selection bias, and so you're going to go and select the thing that was the most effective in the past, and it doesn't end up being the most effective thing going forward. So when they started redoing those kinds of studies and trying to take into account selection bias or curve fitting, then they found that didn't work. That the technical analysis didn't work. So now what they've done is they've kind of moved on. Like that's the funny thing, is that the researchers have moved on. Like the researchers know technical analysis isn't very fertile ground. So the people that are on the technical side, they're doing machine learning stuff, and I've seen some pretty promising looking results with machine learning, right? So I saw this one the other day where they were doing a regression, predict the next day's returns, and a Mars model, MARS, so some sort of a machine learning algorithm, was the most effective. And it was like a 0.0001% mean square root deviation, which is like really accurate. Which data did it use? Oh, I don't know. I'd have to go back and read it. I went and I put it in my stack, and I was like, well, we have to read more about this later. The issue is I really want to get more into the machine learning stuff, but in order for me to do the NinjaTrader, it seems to not lend itself very well to it. I think I can export the data out and do some work on it, but I just haven't done that yet. I just haven't found the time. There's other things that kind of keep ending up being higher on the list for me. Well, man, now they're kind of saying that I could have maybe even gotten away with 6-spot 2. The ZB is kind of leading, so getting that steepening here along with it coming down, that does make me a little bit more confident that this move could continue. If I learn Python, can I program? You could, yeah. Probably there are some libraries that would make programming that route quite easy. Like when I've gone and looking at the machine learning stuff, I'm a little shocked about how easy some of these frameworks have made it. Like the thing that it's actually a little frightening, because you can really take advantage of and use these machine learning algorithms without really understanding how they work. That could be a problem. That could really be a problem in the future. You have all these people making these algorithms based on stuff that they don't really actually understand, and then they abuse it. I'm just kind of watching to see now that we're down here if the flow starts to become more aggressive or not. That take at 12.5 was relatively aggressive. There is some pushback though. Can you believe it's been 30 minutes already? You know, the thing is that there was a point where it was kind of coming back to 61 and I was thinking about playing around with it again. But I didn't want to do it because I thought maybe they won't film me if I do that. And it came back up to that 62 really fast after that. Like that when the move actually happened, it was quick. Yep. From 644 and then to 650. I guess it was 5 minutes. It was a little bit longer. Can I build abstract, more general principles on top? I don't know what you mean by that. I can only say that there are a lot of learning resources out there for Python, and that you can probably get yourself into whatever level you need just from reading off the internet to do some pretty wild stuff with Python. Frankly, you can do it with other languages too. C#, for instance, is just that the libraries that are available in C# to do that aren't compatible with NinjaTrader. Because NinjaTrader is on an older version of the framework. Is still pushing. This is going to be one of those days where I'm going to be like, I could have bought 625 and still made $50. It kind of feels like that, doesn't it? But I'm kind of looking at this as I don't know if the news itself is really leading to that much volume coming through here. I don't know, 10,000 or so far. You know, in order to have a kind of day like I'm thinking about, we would need to have like a $30,000-$40,000 sell. Is somebody really coming in and doing that? I don't know. It kind of feels to me more like that the treasury market has just been volatile recently. And so that's where we're getting the liquidity isn't holding as much. I want to make a bot that speaks and understands human language more naturally. Well, yeah, you can go and you can make a bot that speaks and understands human language. Probably to make one that is more effective than the ones that you can currently make with Python, you would need to understand a lot about it at that point. You would have to be able to pull open that library and understand the code that makes it work, which is a lot of work. Like you have to learn some statistics first and not the statistics again. Yeah, you know, I'm reading Dune right now, but after Dune, I think I'm gonna go and get this statistics book and start studying that in the evening to try and get myself to a higher level of understanding of statistics. So I understand a lot of really basic statistics. I kind of understand where our understanding of statistics is too naive, but then I don't know enough about it to be able to actually make use of those advanced statistics to make money, you know? I wonder how well AI would be at reading and comprehending news articles. Not that good, I think. So something that I've noticed, and I can only say this just from watching the market, there used to be, particularly during the Donald Trump years, a lot of robots that seemed to be reading the Bloomberg news feed and trying to take trades based off of the Bloomberg news feed. And so there was a time period where we would get headlines and the market would grossly overreact to those headlines. The most famous example, or the one that stands out in my mind the most, at least, was the Peter Navarro incident, where on a Fox News nightly interview, he said that the trade deal with China is basically dead. And he wasn't making any kind of official announcement or any kind of policy change. He was just kind of saying, it doesn't look too good, which is something that we already kind of knew. So the market made this huge move, and then everybody went and actually watched the clip and realized that it was a nothing burger, and the market went back to where it was. And that had created a big shock in the markets because robots read the headline and interpreted it wrong. And that happened a bunch of times, especially off of Donald Trump tweets. There was a number of times where we saw the market do something, and we here on the stream took the opposite of that trade and made money. Big trades. And I think that what happened was those robots screwed up enough times that the people that were running them turned them off or gave up on them or blew out or whatever, because it's just not as common anymore. Like it's one thing to read a headline and say, is this bullish or bearish? But it's another thing to, take a headline and really do like a sophisticated analysis of how this affects the economy and what I should do in response, You lost some money that day. Ouch. Well, it really sucked for anybody that was in a position overnight, right? Because you had this move going the opposite way that was complete bullshit. And surely some people got stopped out of it, huh? I wasn't able to trade that specific one, the Peter Navarro incident, because it's outside of my trading time. When I saw the headline, because I saw it as soon as it came out, I went and I posted it in the Discord, and I said, I think you fade this, but we didn't trade that one because of the time. What do you think is the problem in intended meaning of the headlines or sarcasm? No. It's that the robots aren't sophisticated enough to interpret what it actually means. like the way that a machine learning algorithm approaches that sort of a thing is it's going to read the words in the headline, and based on the words and what it knows about the market, it tries to interpret that as bullish or bearish sentiment. That's, like think about these sentiment analyses where they go through and they say, how does Twitter feel about the economy? How are they doing that? They're looking at every tweet out there, and they're looking at the words that they're using to categorize them as bullish or bearish using like statistical models, right? So it has a statistical model that it knows that the Peter Navarro is an important figure, and what he says matters, and he's saying something negative about the trade deal, and so that's bad for trade with China. But it doesn't have the ability to come in and say, oh, but that happened on Fox News and it was just a throwaway comment and it doesn't mean anything, right? Every morning here now, Brannigan Barrett has tweeted something somewhat bearish. I do think, by the way, I think that early next week, largely because of the gamma, that we could have a little bit of a volatile, because it's been happening, right? That every time, right, at the beginning of this, you get volatility comes in, and then as things go to expiration, everything goes back up. So probably what I would expect to happen based on what we know is a bear market on Monday, and then by Friday we're back to buy the dip. Well, there has been a little bit of a change in the flow here. I don't know if they're going to come back up. I think that because I only have one contract on here with my sim trade, that I'm going to let it come back up here. And then if I see another change up here, I might take a shot on another short. What's this? Oh man, So I tell you what, the Bitfinex Twitter account, I enjoy reading that account because there are so many people on Twitter that say stuff about Tether that's just like demonstrably untrue, and he doesn't take any shit from everyone. Anon 35353. So it looks like a random account. This guy has repeatedly said that Tether had zero, I quote, $0 since 2017. It's been proven in court that Tether had more than $0. You can read all about it in his book, which you can buy for $20. And then he goes, oh, really? Let's read that. The OAG's investigation found that starting no later than mid-2017, Tether had no access to banking anywhere in the world, and so for periods of time held no reserves to back Tethers in circulation at the rate of $1 for every Tether, contrary to its representations. It's like, yeah, they didn't have any money. It's kind of funny that people still don't believe this. Funnily enough, though, it's been well proven, and they still don't care. How do you distinguish between throwaway comments and important ones? Well, I think that if you were watching that news program, you would not have thought that he was making a policy announcement. Right? I mean, that's how I was able to make that determination. So I said, oh, well, you don't make a major policy announcement on a small time evening Fox News show, you know? And the market was reading it like, this is it. This is the trade Armageddon is about to happen now because Peter Navarro said the trade deal is dead. You know? But this is where you have to be informed, right? One of the things when I say informed is like, you know, you need to have stuff and you should have information and news that you're basing your trades on. But a lot of it is just consuming a lot of news, reading a lot of stuff about the markets, and knowing your stuff so that when things like that happen, you know, you can make those kinds of determinations for yourself because you're the expert in it, right? That's got to be the goal. Here on the treasuries, our goal is we want to be experts in treasuries and everything that's going on in the market about treasuries. It's hard because we're retail traders, right? But that's the goal. That's what I mean by being informed. It means reading a lot of Zero Hedge and CNBC or Bloomberg and reading studies that come out and watching all the headlines. So you know what, NASDAQ, you're saying a bunch of things that I only understand what you're saying because I've seen TikToks recently about literary prose in Arabic languages. Language has two opposing aspects, conventional and conversational. The conversational deals with context. Because I know that in Arabic that there are like very significant differences between like conversational and like formal writing and stuff. But we don't really have that in English, do we? Something that I thought was really weird. Well, I shouldn't say weird. I thought it was really interesting. Was that in Arabic they would have like this prose. There'd be like a way of saying things that almost kind of has like a rhythm to it, but then they'll make a mistake on purpose. They'll have this pattern, and then they'll make an intentional mistake. And the reason that you make the intentional mistake is because you can't ever do something 100% perfect because only God can do something perfect. And of course, you could try and you would never do it perfect, but by making the intentional mistake or acknowledging that we'll never measure up to God, I thought that was a really interesting cultural take. I was like, wow, like that's something that is ingrained into the very language? What? Wow. So I can totally see why you would be looking for those sorts of things when you're reading the news. But no, it doesn't help you there. You just have to understand. You just have to understand the actual implications of the thing that they're saying and see if it really actually affects people's propensity to buy or sell or not. There's concrete language speaking plainly of objects one uses their senses to observe, and then there's abstract language using metaphors and speaking of abstract philosophy a priori. Yeah. I don't know how to explain it. There's the people that are experts in these languages, like you would think that it would be a simple thing, but it's a really quite a complicated thing. Like to me, it's like, wow, that is a lot of brain power to put to in a subject that most people don't care about, you know? like I think I'm kind of niche because I care about interest rates, but man, there are some people that are way deeper into their thing than me. As hard as I can try, I'm never gonna be more nerdy than that, man. The fuck? Hold on. Oh, I didn't turn my microphone back on. So, like, I heard the door opening, or somebody was at the door. I'm like, is somebody trying to break into my house? What's going on? It was my wife went outside, and I'm like, well, why would you be going outside? That's weird. Apparently, there was a note on the door she could see, and so she opened it up and grabbed it. Kind of freaked me out for a second there. I am studying linguistics and may write something about natural language processing applied to computer language. Yeah. I think you can definitely do it. Just be advised that the sort of thing that you're talking about is like a 10-year journey, right? Gemini raises $400 million to build a metaverse outside of Facebook's walled garden. Ooh, okay. Getting more serious, folks. I'll be interested when somebody finally puts out a metaverse network, because on one hand, I'm deeply skeptical. Like, I think that the metaverse is in a bubble right now, that it's gonna crash twice. Here's what I think is gonna happen with the metaverse. There's gonna be a metaverse crash in the next year, and then they will actually build these metaverse apps, and there will be another mania. But it will be mostly amongst the nerds. There'll be a mania, and there will be people who will make like tons of money from playing in the metaverse. And then there will be another crash. Like one of the metaverse economies will make a mistake or something. There will be a crash, and everybody will make fun of them and stuff. And a bunch of companies will go out of business, and that'll be like the .com bubble, you know, and then something will rise up above that. But then at that point, there will be like a real actual metaverse, and it will be a big thing. It just won't be what we think it is going to be today. Because I think that what people describe today sounds like a dystopia to me. Metaverse seems like a lot of work. Agree to the thesis. I want to sit at a computer and space out. Maybe something that does not involve movement. Yeah. Well, and that's the thing, is that I think that the metaverse doesn't necessarily have to be tied into VR, right? It can be varying levels of things. I think that a metaverse, for us, probably involves having a bunch of spreadsheets out, and you know what I mean? Like I think that for us, a metaverse could be like EVE Online is, right? Because I think the thing that they're not really doing very well right now with the metaverse is the actual killer app, is like the killer application. They have like this idea and this vision where you go into this virtual world, but then they want to create this walled garden. So it's like, what is it that you're going to do in this metaverse that you don't do in the real world? That's going to make you want to put all of your effort into the metaverse. Because if you have to have an economy around it and everybody's going to be involved in that economy, why would they be more involved in your metaverse economy than the real economy? There's no reason for that, right? But when you look at the technology, there's some niche applications. For instance, one of the things that has done really well was they've done virtual concerts in Fortnite, where a bunch of people could come and watch the concert. And, you know, if you were doing a concert where everybody had their VR headset stuff on and everything, that would work. And you know what? Like, the thing that's popular in VR chats is they basically have like clubs. They basically have clubs. And so you can have a virtual concert where literally everybody is able to come, but you're still able to have the interaction between members of the audience, of everybody being there and seeing each other and that sort of a thing. Okay. Like, that's a cool application of it. I don't think that is an application that everybody's going to be into. I don't think that is the world-changing industry that they make the metaverse out to be. But like, there is a niche application of it, right? I think there's potential primarily for AR. AR could allow more information readily available. Yeah, okay, so there you go. You got it. You hit it right on the head. I have to say, G59, so far, I mean, I shouldn't make too, because we have a very small sample set, but you seem like a smart cookie. Their augmented reality and virtual reality could have significant implications for trading and commerce. 100%, because there is a dichotomy. There's a problem with the difference between the electronic markets that we have today and the trading pits that we had before. There was the ways that information was traveled and related to people, and the ability for you to see who was doing what, and the ability to, barter a transaction with people, especially in options. Okay. There's some things about options that really just only work in the pit and don't work as well in the real world. In online trading, options ends up being a completely different thing. And there's some real problems with it, because it's basically like you give the robots complete control over it and they can do dumb things. So if you were to make an exchange where you were still using a limit order book, but it was there was a VR presence attached to it, right? That would be huge. I keep coming back to that idea. I've actually looked in VR chat to see, do I have the ability to do that? And every time that I've looked, it kind of seemed like that kind of a extension was a little bit much. You know what I mean? Maybe I should go and try and make one with Unreal Engine, because that's going to be one place in the Epic Games is definitely putting a lot of money into trying to make a metaverse application. And one of the things that will probably happen is you'll be a network. There might be different clients, and so one client might work on Unreal Engine and that sort of a thing, right? And if theirs is the best looking one, which it will be, they'll probably have a lot of power. But that's a lot of work, and then I forget about it. So in the 10-year here, they were able to get back to 1.4, but the yields did not come back to 1.61, not even close. Star Citizen, they're trying to do some... I haven't looked at that lately. The problem with Star Citizen 1 is I feel like that what they're doing is like just way too ambitious. But then the other thing is that it always seems to me like the things that the people that like that are into Star Citizen cares about are things that like, who gives a crap? Who gives a crap? But if they had a virtual economy with a virtual trading floor, I'd be 100% in on that. Well, there might be still some buying in here. And I do see some of the volume flipping around, like the ZB, even though it kind of seemed like it led on the way down, the cumulative delta has actually been slightly positive all through this. I am seeing some buying in the 5-year, and I wouldn't say buying in the 10-year, but like a little bit of at least a reversal in the 10-year on this move up. So that's not enough for me to be like, reversal. Maybe, I'm kind of thinking about the sim trade here, that I might want to do something in here. Well, we do need to think about the S&P 500 starting in 3 minutes, which I'm a little concerned that might be, well, because we're at 4,700 right now. I don't know about this. As of late, they've been selling off first in the S&P 500, right? And you might see, a sell-off and then a reflexive bounce. Oh boy, who isn't the US actually bully? Australia, as the barking dog of the US, cannot recognize its master as the real bully. This is understandable. Talking about China bullying Australia. The government is buying 10 million COVID pills from Pfizer for $5 billion. Wow, really? It's going to be very interesting to see where this goes with COVID next, because we were all led to believe that the vaccine would end the pandemic. Maybe we were just kind of, that was a reflection of our own hopes and not actually what they were telling us. Maybe we misunderstood, but I was given the impression that once everybody has the vaccine, that it wouldn't be a problem anymore. But now what are we seeing? We're seeing that the places that have the highest vaccination rates are having huge explosions in COVID. And it's not just like the COVID levels are high. It's like dangerous levels overwhelming the hospitals, big waves all over again. And in a time period where we wouldn't necessarily expect to see that. It'll get worse in the next month, right? And so it appears to me, and I think that we still need to do some more research, but it seems that there is some sort of waning immunity, right? You take the shot and then it only helps you for like a year. Wait till your kids start dropping from heart attacks. Well, that is a problem, but we should be really careful to not blow that out of proportion. Man, I'm always coming into conflict with the rationality paradox, right? Okay, yeah, it is a problem with children and young people. Getting the vaccine can have an impact on your heart, but you need to realize that the prevalence of this is very, very, very low. It's just that's only kind of ends up being relevant in kids because the prevalence of the heart problems is about as prevalent as a child actually dying from COVID. Okay, but it's still we're talking about like 1 in 2,000 or something like that, right? Or it's like some ridiculously infinitesimally small number. Still, when you have these vaccines where it's enough that other countries have basically halted it for children, and now, but here in the U.S. they're pushing to have all the children vaccinated. That's really startling. That's really, really startling. And then on top of all of that, it doesn't actually solve the problem. I mean, that doesn't mean that it doesn't help. It doesn't mean that it's not a positive thing, but you still got COVID. So now we're all back to what we were saying at the beginning, which is like probably everybody's going to catch it, and we're going to have to learn to live with it. And flattening the curve is okay, but then beyond that, we have to learn to live with it. That still appears to be what would have been the correct call. And people are slowly starting to realize the reality of what's going on. And I think, and I'm noticing on Reddit, some of them, when they realize that, are a little upset because they're like 9 months behind us, right? We were upset 9 months ago. Hey, this should be over. You can't be safe from COVID until you have a QR tracking app on your phone, and you can, yeah. Well, and people are catching on to this whole thing that's like, this doesn't seem like this is about protecting us from COVID anymore, because the measures that y'all are going for just are not justified by the danger that it actually poses. You're using this to try and coerce us into giving up our rights so that the government can track everybody's movements. And I think that I don't have proof that that's happening, but I think that that's a legitimate concern and criticism of the current COVID policies. Yes. So S&P 500 did have a sell on the open that, like we expected. Shouldn't say we expected. Because I felt like that was a little bit of a gamble call, but we did predict that. But I was also saying you probably should get a reflexive buy. So we kind of got to watch that. So far in the S&P 500, we're not seeing that. They're still selling. To my health. Now, I guess while Uzi's here, the other thing we got to talk about is the Kyle Rittenhouse case, man, because that's that kind of had some wild stuff happen, right? So apparently there was this video that was kind of introduced late where the prosecution tried to use it to argue that Kyle was pointing his gun at people, and that's why they started chasing him. But it was like a really low resolution video, and you couldn't really see it and everything. Well, now we find out that the prosecution had a higher quality video, and that they didn't give them the higher quality video. And there was the proceedings in the court over this, I thought were just like wild. I was like, wow, what a zoo. What a zoo. Like you realize that if he gets if he, well, I'm sorry, I was reaching for a word there, and I think I led myself on the completely wrong lead-in sentence there. If Kyle Rittenhouse is found guilty by the jury, he will almost certainly be. It will almost certainly be called a mistrial. Like, the judge is sitting there, and that's got to be what he's thinking in his mind, is if they say he's guilty, then we're going to have to call a mistrial. He wants to just throw the case out right now, but he's not, for political reasons. He's saying it would be better for the country that we actually get he's innocent verdict. But if he's not found innocent, there's so many problems in this trial that it won't hold up. It will get appealed. Okay, the treasuries are pushing up there, and there's a pretty big iceberg. Well, not an iceberg. There's a pretty big order there holding it. Okay, he's moved it up. The book has thickened up as they've done this. That's not the kind of action that I want to fade. So when I was looking for maybe they come back to 1 spot 6-1. Oh man, I'm not seeing that anymore. Jeez. Okay. Well, that was very interesting. So the buyers started to get very aggressive there, and some sellers responded back. I think that the buying is being triggered by the S&P 500 extending down further. She didn't get selected. I'm almost positive that if I was ever called for jury duty, that there is absolutely no way that I would ever actually be selected. I'm everything that I've seen about the jury selection process is like somebody that's highly rational and prides themselves in knowing what's going on would not be selected because they know too much they have a pre-existing bias, and I would never get selected. So the S&P 500 is not... Things got a little exciting there. They've bounced a little bit off of the lows. Things are calming down now. I don't know if it's safe for me to buy over there in the S&P 500 yet or not, but I'm going to be too afraid about taking this price and having what happened to me yesterday, where I had a great trade and it's just barely got stopped out, you know? Bro, if you were selected for jury duty, you'd never reach a verdict. You'd analyze the evidence until your covenant was finished. No, I would take an empirical approach to it, and I would have a decision. I would know exactly what I thought before we even went into the jury room, and then I would convince everybody of what I thought it was, and I would dominate everybody else in the jury. No. That's the sort of thing that I think that they would be like, no, I don't think that you want to select him. He's too smart. It is just, I'm looking at it. Every time I see those jury selection processes, it's like, if you're smart and you know what's going on, you don't get selected. That's right. I called myself smart. Deal with it. My wife thinks I'd make a good juror. Our lawyer thinks that you'd make a good lawyer. Hey, you have a lawyer that you talk to regularly? That's, useful. I wish I had a lawyer that I talked to regularly. Could tell me these sorts of things. There you go. So now 15. Let's reset things here. I'm not seeing the spreads change. I'm also not seeing the volume. Oh, that's super interesting. So, I said there, like, the buyers looked pretty aggressive, but there was a lot of bid orders in that aggressiveness. The sellers responded back with actual market orders. So the cumulative delta in the 10-year is actually at the session lows despite that strong push back up. So that might be in line with my original idea. Yeah, that's weird. Oh, because it's steepening again. I was thinking it's a little weird that the rate ticked down there a tick, but it's because the ZB went down on the steepener. Okay. You gotta keep a tight leash on this. That was a good tick up though. So that wasn't the best spot, was it? Oh, good. Interesting. She was impressed by the evidence I gathered, organized, and presented, so she had minimal work. Yeah, okay. They're doing some weird stuff over here in the treasury, to be honest with you. No, that doesn't really help. That doesn't really help. Kind of searching around here, trying to figure out what's going on. CB leading index at the top of the hour, but that one doesn't matter because those all of the factors involved in that come out before. Sellers in ZB keep saying no to that first 5-minute high. But I mean, it looks like they're going to keep pushing it, right? That's kind of funny to watch that middle price in the micro 10-year. The E-mini's still being a little dramatic here. In fact. So there might be an iceberg here at 15.5. Let's see. Nope. You say push to 27 if they do. They backed off a little bit, but we might get another push. You can see the rate is still kind of coming up there, though. Yeah. Oh, did I get stopped out in the ES again? Yes. Phooey. Put this up over here. Yeah. I haven't done so well with those in the E-mini. I mean, I'm kind of just throwing them out there, but they're not working very well lately. I don't know about this one, guys. I kind of think that they're going to keep pushing it up. I am not fifth in line. Come on. Really? Okay. Interesting. Yes, still looks a little choppy over here, doesn't it? But it is starting to bounce now. So I guess we'll see, because that movement up in the treasuries may have just been flight to safety, right? Finished off on rumor. When you're done remodeling, are you going to sell it? I'm seeing clicks, but they're over in the E-mini. I'm concerned that we might be in a situation where the flows don't help us so much in the 10-year because there was a lot of transactions that happened at 15 and 15.5, which kind of suggests that this has got two sides to it, right? So I'm not seeing like the really low liquidity that would make me be like, yeah, like they're stuck in a hole. And note that in the 10-year, or sorry, the 30-year, that there's like a lot of liquidity on both sides. It's 300 by 300. And they just got, one side just got hit there. Interestingly enough, these guys did not respond to that at all. It's just still steepening. And the 10-year tries to trade up. They're not quite able to get the 30-year to come along yet, though. Oh, the S&P 500 turned down again on me? When your target is closer than your stop and you're losing like multiple times in a row, you're definitely doing something wrong. And I need to like really watch the S&P 500 and like get in the groove of it to have a good trade over here, because I'm just getting it wrong every time. Well, the 5 and the 10 were starting to make another little bit of a push forward, but then the 30-year refused to go, and that 30-year went out again. And ES is getting dangerously close to those regular session lows. Okay, so there was some new lows in the S&P 500 and a little bit of a stop run. I actually kind of see some guys trying to buy that, but okay. And there's a 10-year trying to make another attempt. 30 years still lagging. So there's some solid bids showing up, though. Okay. So a bit of an iceberg at 15.5 on the offer, and then as soon as it ticked up, there's a bit of an iceberg at 15.5 on the bid. S&P still not looking too happy though. Okay, there's a strong uptick in the 10-year. Still okay. Well, that's kind of weird. You're still not getting the 30-year to come, but it is definitely steepening here. So maybe it gets dragged along eventually. Sure glad I got out of that sim trade when it started coming back, huh? Somebody stacked at 16. I haven't seen this in a while. So when we start to see the liquidity add like that, that is very, very much a sign that a large institution of some sort, usually a bank, is executing a large meta order buying here. Now, I don't know why they would be doing that, but there was some aggressive selling there at points, and it seemed like those buyers were more than willing to take them. Those are all just kind of things that say to me, buying meta order, right? Like these guys, they're gonna buy as much because they need to buy like 40,000 contracts or something like that, right? So the sellers gave them plenty of fills, but why was the seller doing it? Was it meta order hitting into meta order, or was that like a bank trading against a hedge fund sort of a thing, right? Is what we don't necessarily know. The fact that the sellers were using market orders kind of suggests to me more of like a hedge fund, like informed traders trying to make a play, right? And losing to an uninformed meta order, which suggests that not only could we continue to move up, but that you might see the guy that sold start to stop out if we are able to bust into new highs. 17.5 would be like a new session high, but like there was some action up at 18 even before the open, so they get through 18, then we might see a stop run. The 30-year did get dragged up with them, by the way, despite lagging quite a bit. ECB's lane, we do not see inflation expectations moving above the target set by the ECB. Okay, now that is one thing that does not line up with our, because if there's Fed speakers, well, let's add the euro up in here. And it doesn't even show it on there. Okay. Now, and one thing that I want to watch here, this is just kind of a theory, but so if this is a larger meta order buying, he doesn't necessarily want it to go through into new highs, right? Like, he doesn't want it to get accelerate on him. So they might kind of back off on the pressure here. But then we could see if other people push it anyways. If that's true, though, then we should expect to still see some buy-side icebergs out there. Yeah. So, I mean, that is kind of in line, but the sellers aren't giving up, are they? I mean, there's quite a bit of trade went back and forth there at 16.5 in the 10-year. E-mini is making a little bit of a recovery there. There's a 5-year coming into 15 3/4. 16's got some size on it. You should expect to see some sizes at 16s. Iceberg level break level. Level break setup in the 10-year at 17. I would say this is not the kind of situation where I would always want to take it, but yeah, I think I'm going to have to say it's maybe a 55% chance that they're going to do a level break here, given the amount of momentum. Because the momentum, it's not insane. Like we've had a hard time reading it a little bit here, right? Oh boy, yeah. Okay, well they didn't pull it at 17.5. In fact, I bet you that there's fills at 17.5 and 18. Could it take more than 13? Could it take more than 4,000 contracts to clear 18? I think that there's a good chance of that. Look at the 30-year though. Are they going to try and flatten it now? Oh, this could get interesting if the flattener comes back, man. Okay, we are hearing as Feds Williams is still speaking. I am hearing headlines from him as well. Okay, yeah, 27 was your spot. Okay. You finished early. You already made money. So did you make money on a short? Or did you buy the dip on that? Thank you very much, Uzi. I think that for me on this one, first we got to make it through 18. If we make it through 18, then I'm going to be watching the overall volume, because I'm pretty confident at this point that there is some sort of large meta order being executed, and it's pretty massive. So I should expect to see, like 50,000 contracts or something in cumulative delta difference by the end. Although I haven't seen one in a really, really long time that had this much two-way action on it, right? Like, we got to realize that there was some aggressive selling every step of the way here. And, so basically the sellers really helped the person that was executing the buy meta order. And we don't know when the buyer is filled. It was also like, where were the legs? That's also something that will really help. One leg was at 735. One was at 8. Okay, so we may, if they're doing it every 30 minutes or so, they probably, that one was probably ahead of schedule though, right? Normally they wait 45 minutes, but if they were saying, oh, there's lots of liquidity, so let's do it now. Oh, that's interesting. This is a fun one to watch. I think we could learn a lot from how this turns out. Yeah. Stick says ball. Or are we cheerleading it to break the high at 18? I do think that if they bust 18, we should see a little bit of a stop run. But it's a little bit. I'd say it's still tense here, right? Okay. Now that one is a little... that last tick, I think, might have been different because... Okay, yeah. The S&P 500 going there for lows again. I did take it short at some point in the S&P, didn't I? Yeah, 46.92. Well, that sucks. Okay. You gonna join us, ZB? There we go. Good girl. Oh, you sent me a... Oh, that's what that was. Oh, you did take it. You took it short on the news. That was a good one. Does the Fed ever liquidate their assets, or do they just hold? They just hold till expiry. Actually, yes. Isn't that interesting? Okay, so only 12.13 to trade 18. That is definitely somebody trying to do the level break. So we didn't immediately see the stops, but they're coming. I bet you they're coming here. That's got to be like they're being stubborn. Still smoking, man. I tell you what, I mean, in Utah nobody smokes. Like it's very rare. You go out in public and you smell cigarette smoke, it's like who would smoke in Utah? In other places is pretty common. But so maybe it's just that I'm noticing people smoke and not many people in Utah smoke. But it seems to me like there's a lot of traders that smoke. Like, you got to do something to deal with the stress of it all, you know? Why don't they buy when liquidity on hand sell? Can you rephrase that, Stick? I'm not sure what you mean by that. I think that what we are seeing is somebody came in and executed a large buy meta order. Oh, when money is short and sell when money is, I gotcha. Yeah, it's a good point. So I think that the problem is the Federal Reserve wants to come in and they want to support things, right? They want to support the markets and they want to keep the interest rate low. Why don't they sell when things start to get high? Is I think what you mean. That's the opposite of what they want to do, right? They want the rates to stay low, so they're not going to sell any of their holdings to accelerate things. And we've never really had the opportunity where things got high, you know? Like first of all, let them taper off their asset purchases and let the market get back to a normal state of mind, okay? And then we're in that equilibrium. Man, S&P 500 just got hammered there, didn't it? Now things are at an equilibrium and we're starting to get inflation and we're all concerned about it. Why doesn't the Federal Reserve come in and sell things? We've never been in that situation before. I think that it would have to be really dramatic for us to be in that situation. You know what I mean? So I think that's why. But I also think that the larger thing is that the Federal Reserve doesn't want the market to have to worry about them exiting, selling back and having a reverse impact. And so they always want to let them just expire. And, they make their money if they let them expire too, which is probably another part of it. Because if the Federal Reserve were to come in and sell it, they would probably have such a dramatic impact on prices that they probably would lose money on all of their transactions. And that would hamper their ability to support the markets in the future. So, good question. So I could be wrong about a couple of those things. Maybe I think about it and I come up with some different answers, but that's kind of like my first impression of that. It was a question I hadn't really considered before. It was always like, oh, well, if they're going to buy it, they better not. Like, what's going to happen when they sell it back in? That would be bad. But then they say, oh, but don't worry, we're going to let them taper off. I'm like, oh, okay, you're doing the right thing. And that was as far as I ever took it. Yeah, I was thinking the same thing. It hasn't happened yet. Doesn't the market go down easier after it goes up? Well, yes and no. So because of the latent liquidity, yeah, and the latent liquidity in this market is a little bit problematic right now, right? Like if the Federal Reserve did sell treasuries, it would be a big disaster for the treasury market, for sure. Okay. A little bit of a fight at 18.5 still. There was some stops. Only 5 there, though, huh? Yeah, so if the Fed sells after you buy RIP. Oh, yeah, for sure. Okay. So if we come back and look at, so Uzi is saying 03. When I look in the 10-year, we should just keep in mind that 20 and 21.5 are all levels from overnight that could be in play here. Relatively close spots. Okay, that was a little bit more of the stops that I was expecting to see at 18. I've seen that before where it goes and it seems like you should see stops there and you don't see them, and then so it's like another tick or two and then they give up. Yeah. Okay, down tick at 19.5. So So what we just saw happen there can be a pretty good turning point, but because again we're definitely seeing a large meta order coming through and everything, what we should expect to see actually is a liquidity hole form and the square root law of meta order impact start to come into play. It could happen at 19.5, but that would mean that we'll be at 19.5 for quite some time now. I love it when I call a level and it gets highlighted on the DOM, but rejects so fast it doesn't trade. Yeah, right. Well, so one thing that we should keep in mind, where would it be? Oh, it's way too far away in ZB. In ZN, it's at 22.5, and in ZF, we're not to it yet there either. 18.5, 18.25. Those are single prints from the 15th. So that was Monday, right? Today's Thursday, Wednesday, Tuesday, Monday. Yes, single prints from the move down on Monday that could be at play. And we tend to get that sort of stuff happen at those prices, right? It would look like Evergrande bonds, 9.99% yields. The square root laws for liquidity holes snowballs. It appears that part of what causes the square root law is the liquidity holes, yes. That the hole forms and then people add liquidity around it, and that kind of is what gets price stuck and constrained. So what you want to do, if it's like, especially if you're trying to move price, right, is you're going to get to that square root law. You're going to get, you take off the gas, let the liquidity recover, and then keep pushing. But what happens sometimes, I'm starting to learn, and it might be happening right here. They're stepping up again. Is that sometimes you've got so many people off sides that they just have to start piling in anyways, Okay, so by the way, we are approaching 20,000, but we started at 5,000 in cumulative delta, so that's a net 15,000 long, given the kind of order that we think we're seeing, and the fact that the S&P 500 is selling, which is very curious to me. I really thought that we would just stick around that 47. Like, I thought that we would see a sell. I did not think that we would see this cratering in the S&P 500, right? So I was wrong about that. But this is turning into a doozy of a move in the S&P 500. So this meta order over here in the 10-year becomes more interesting because it must have been a hedge for what they were planning on doing in the S&P 500. Although I can't say why that's happening. I don't know. Manchin has not decided whether to vote for the Build Back Better bill. That's interesting. Let's go to Zero Hedge and see if they've got anything on the action so far. Usually they have a little bit of a synopsis of what is happening so far. Does the Fed have a brewing velocity problem? Well, we're going to have to read that later. The number of Americans on the dole mysteriously jumps back above 3 million. That's weird. So they touched 21.5. Did they? I did say 21.5, right? Now that's the 5-year. 22.5. Okay. Maybe because less TA-based order levels prices during a liquidity hole, creating a more Gaussian normal standard distribution like a bell curve. I don't get what you're saying. Less TA-based order levels prices during a liquidity hole creating. Well, okay, so one of the things that you got to realize is that where there is kind of a point at which you will get the hole, because you could kind of you could look at the impact, right? But for us, one of the things that's really going to tip you off to it is large transactions taking place up there, right? Large transactions is kind of okay. So for instance, that 21 having 4K on it, that doesn't necessarily scream square root law to me, right? What would scream square root law to me is like 20.5 is light, 21 is light, 20 is light, and like a ton of trade had happened at 20.5, and like, you know, it slows down because all of the people that were trading, like they traded, like they did the thing, you know. So I'm realizing now I really should have had something down in here. Like 90% of the volume traded is non-TA traders. I mean, I don't know. I'm actually going to say probably not. So I think the way that we would approach that is if we look at the Kyle model, and here in this particular case, even though I don't think that this meta order is being executed for fundamental reasons, but it could, because of the S&P 500 dropping. Maybe it really was done for fundamental reasons. But I think that there's a really good chance that because of the size of it and the timing and everything else, that it may just be a fund things. You know what I mean? But we can place them in the role of the informed trader for the sake of this exercise. Okay, if they're the informed trader executing this meta order, there's the both the informed trader and the liquidity provider, the market maker, rely on the noise traders in order to work. You know, they like the person that is executing the meta order, he needs that noise out there. Otherwise, the market maker will see what's going on and, you know, pull his prices, right? So you need to have a certain amount of, you know, TA traders. I wouldn't even say them TA traders. Let's call them noise traders, right? And to the point where for them, it would be optimal that the majority of the volume is noise traders, right? That's what's optimal for them. Well, darn, it sucks I didn't get my fill down there. I mean, the thing is that we don't even have to come in and say like, what are they using Because we know that technical analysis is basically just noise. So we can and even all of the guys that their edge is taking on risk, right? We can just kind of put all of that into this category of noise trading, right? And what we're interested in is the informed trader. What is he doing? Especially when we get signs that he's doing that he's out there, like we did, right? So if we got signs that he's out there, then we've got to think about two things. One, when do they start to reach the square root law of market impact? Two, when is he done executing the meta order? How large is this order really? Given the kind of move that we had in the S&P 500 there and the possible correlation to that, we should look around where else. Well, the 6J is up. Bitcoin is taking a bit of a dive. Oh, it is taking a bit of a dive. It is. Gold and silver are actually holding their prices. Okay. But that doesn't really tell us much about that. Anyways. So given all of that, probably the thing that's most interesting to us is he done executing the meta order? And so I see a cumulative delta difference of 15,000. It's possible that that's it. But given the type of move and trade that this is, it's probably what they're going to do is they're going to let the order book chill out here a little bit and push again. So that move again, we come back over here. Let me minimize that. There was this move that happens at 7:30, 8. We're not to 8:30 yet. So they might not, well, man, and that particular leg went. That particular leg was probably like the person executing the meta order didn't really want it to go up that fast. Okay. So given all of that, it could be a while. I'm kind of looking at this like, geez, it looks like that the meta order is at the very least taking a break, and I probably want to take some profits, and I'm really mad that I didn't get filled down there. If insider trading laws didn't exist, would all market makers be wiped out and replaced with informed traders instead being the market makers and providing liquidity? No, because the market maker is able to offload that risk onto the noise traders, right? But if too many of you guys got smart, if too many people started listening to me and they said, oh, you know what, Seth? You're right. Technical analysis is mostly noise. Taking on a lot of risk and making money that way, it actually is in the end. It's just noise trading. I should only take trades when I actually know what's going to happen, when I am actually the informed trader. And if I'm not, then I probably shouldn't execute something. And then all of a sudden you have a problem because there wouldn't be as much noise in the market and the informed traders wouldn't be able to hide their moves and the market makers wouldn't be able to take their losses. And one of those two sides would take the hit. But the market would be more efficient too, or rather the market would be more reflective of available information, which would be a good thing overall. No, informed traders don't necessarily put limit orders. In fact, I think that there is some evidence to suggest that informed traders prefer to use market orders. Although that is less true in the treasury market. Yeah, exactly. So the informed traders would be setting the prices. Yeah, I think in that kind of situation, the informed traders would have an advantage and market makers would have a real problem. But I mean, it would be tough for both of them, though, right? Because how does the informed trader hide, right? it would basically be like, as soon as you start to see volume moving, you know that something's up. Okay, Fed's Williams talking there. The Fed is conducting research into central bank digital currencies, beginning with technology and moving on to policy issues. It's early days to think about all of the CBDC issues. I didn't realize, or did I realize? Okay, that is weird. Williams, oh, okay, he's been speaking for an hour. So he's getting to the end of his speech is what's going on there. Some stops there at 20. S&P 500 possibly turning. Okay. If the insider trading got too much, then there wouldn't be any liquidity left, so the only way an informed trader can make money is by placing a limit order? Maybe. Maybe. I don't know. I actually think it'd probably be more complicated than that, though. I think that, if everybody became more informed, that wouldn't necessarily mean that noise trading would go away. It's just the noise traders would be the slightly less informed ones, if you know what I mean. Like in our current world, the big advantage that we get is that the majority of retail traders want to be uninformed traders. So they're kind of giving it to you. This is probably not a scenario that we would ever have to worry about. But yeah, I mean, the bigger thing for the insiders too is like, if you're an insider, you have inside information, but there's not enough noise trading out there to cover you. That wouldn't necessarily mean that you wouldn't make money. Is just the amount of money that would be available to you in any one individual trade would be considerably less than it is now. Right? If you're still the only person that has that information, you still have an edge. Is just you can't trade as big of size. System cleans itself. There's something Philip talks about with firms going bust. Yeah, well, I think that has a lot to do with like regime changes and stuff. Well, I'm a little bit torn about what I should do because I'm not so sure that I'm going to get a very good exit here before I'm going to have to go for the day. We are kind of returning back to the scene of the crime right now. So you just got to YOLO it. Well, I don't think I have too much serious going on today, so I may be able to try and let it wait. At the same time, though, I'm not. I don't think that we should be looking for like a trend day. I think that this should probably still be a double distribution, but our order is probably still in a spot where we can get out on the distribution. It's just there's also a possibility of it reversing, right? If all market makers go broke, then the only way you can profit from information is to get filled by less informed traders. Well, you don't want to trade against the market maker, right? You want to trade against the uninformed traders. Mm. So I don't think that yeah, like I don't think that you can get a situation where I guess what I'm saying is I don't think that it ever goes into a spot where there's no market makers left or there's no uninformed traders left. There's always going to be a certain percentage of market makers and a certain percentage of informed traders and yada yada yada, and it's all relative to each other. But what you will see is the overall market liquidity could be less, right? Which is just kind of I'm trying to make a bigger philosophical hint here that the market in a way relies on a certain number of people not knowing what's going on in order to function effectively, right? Like that the more clueless rubes that are out there in the market actually the better it is for the functioning of the market. which is why, you know, that's why Goldman Sachs isn't out there going and saying, okay guys, this is what the square root law of market impact is and yada yada, because it's not in their favor for everybody to know that. Frankly, it's not in our favor for everybody to know that. But I know that I can only have so much of an impact of people. If I had 1 million YouTube subscribers, I wouldn't be saying this stuff anymore, right? If I was a cultural phenomenon, I wouldn't be saying this stuff anymore because it would hurt the market. But the market maker always has to be the more informed one. Not necessarily. I mean, so a market maker really, really benefits from being informed, right? But the market maker's edge is really more to do with his ability to get at the beginning of the queue and take on a lot of risk, right? The market maker, if you could get at the beginning of every queue and you had enough money that you could put orders at every price, then you could be the market maker, right? And then what do? You adjust, you say, I'm going to put orders at every price, but actually I need to cancel this one because there appears to be some informed trading going in here. I need to pull my prices to account for the probability of informed trading coming in, right? Yep. Market maker edge lies in getting paid to provide liquidity. Yeah. And when you go and you do the math with it, generally speaking, the market maker should make, on average, 1 tick per contract that he traded that day. But they have to account for the probability of informed trading, because if there's informed trading and they don't do that, then they're going to lose money. That's why you got to watch for it. You got to watch for those signs that the market maker thinks that something's going on and he's pulling his orders. Okay, so I am the way that this is going through really strongly suggests to me that at the very least that Metaorder, sputtered out. So remember, I was saying, I think we're going to learn a lot from this. Yeah, so I think that the Metaorder went through there and it got away from them. And that's why you're getting such a deep pullback. Because this action up in here wasn't the Metaorder continuing. This was all of the idiots that decided to sell it here having to stop out. Idiots. I shouldn't call them idiots. I'm grateful that they took it, but I want my fill at 1.591. Also, what else is hurting here is that the yield curve is steepening back up. So when we started to get that rise, like the 30-year was coming up, right? The Hill opinion, the folly of a no first use nuclear policy. We'll have to read that. That's an important thing to The important issue that is being discussed in our society. Like now I can't even get 20. I've been watching the 20 and like, see, look, there's only been 4 there. At 6.01. Warren Buffett says you don't need a lot of IQ to do what he does. He says we all have a lot more IQ points than we need. Well, I think that it's yeah. Oh, there you go. It's funny you said that. So every once in a while, it's like the internet or the TikTok algorithm knows exactly what it is that I need to see. And I think that even some of you guys might have been hinting at it, or we had gotten hints of it before, because when I looked at my book list, and I had books on my list about rationality. But the video that I saw yesterday was about the paradox of rationality. They're saying that certainty is like the opposite of rationality. Because the rationality, you have to come in and you have to say, well, this is what we know based on the research, and it tends to be true, and so on and so forth. But what people want to say is, it's this. And there's this kind of a really strange thing that happens, and that I think we're seeing in our society more and more, because people have realized that this happens and are intentionally taking advantage of it, where when you have a game system, you might have a rational answer about what is the best way to play that game. But there are people that if they act irrationally, they actually do better. And this is the rationality paradox, right? So, it very much applies here in trading, that if you were rational, that you can take a rational approach to trading, which is what we're trying to do. I keep calling it like a scientific approach to trading, but I think that what we should be calling it is a rational approach to trading, right? You can take a rational approach to trading, and that should, on overall, lead to better results. And I think that for the majority of people, that will lead to the better, a better result for most people. But there will be people that will do the irrational thing and will be rewarded significantly for it too, because of the rationality paradox, right? And I think that that's kind of what comes down with Warren Buffett, is that what he does is not necessarily super complicated. There are books out there that you can read about how to read into the balance sheet and how to determine how he picks his stocks and things like that. But the advantage that he has is that he is very rational about how he does it. And it's very difficult for a person to be that rational. I might have a propensity to do it largely because I'm on Adderall, right? But there will be people that will be successful by doing irrational things. And then what's going to happen? That person's going to turn around and they're going to say, I was so successful doing X, Y, and Z. And they're going to write a book about it. And then because they have the certainty about it, use this and you'll make money, they all decide to go and follow that instead. And this is the problem that we keep running into, where I say, here's what we know. You should base your trading on this. But we have a very difficult time convincing people to do that. Even people that think that they are very rational and are very good, they want to go and follow the opposite. They think they're rational, but the reality is that the allure of the irrational is too much for them. They don't understand that it's not rational to follow a trading strategy just because somebody else had success with it. That you really, the rational way to trade is to have evidence about the way that the market tends to behave that can really be firmly and empirically established, and then to devise a strategy that takes advantage of that. So the biggest one that we have is that we know from the empirical evidence that markets do not accurately reflect all available information. Ergo, we can use the information that we have in our trading Warren Buffett has the right idea, much more simplistic approach, like you said, and even just the advance of buying low-cost index funds that outperforms an entire group of quants. Yeah, although the problem, though, is that, everybody's been saying, well, not the problem, but Warren Buffett hasn't been doing so well, right? So Warren Buffett's so good, but the value is just doing very poorly in this environment, right? So he has a strategy that favors value, and when we come into growth, he doesn't trade as well. So we can't say that the way that Warren Buffett trades is airtight, right? I think the reality is that orders move markets, and the way that Warren Buffett approaches markets does not account for that. And if he had accounted for that, and he had changed his trading strategy from instead of looking for value, look for where orders are going to come, that he could probably be doing well in this environment too. You get what I mean? So being rational means that we are making our decisions based on a careful and studied analysis of empirical facts, right? Let's see what the dictionary says. Based on or in accordance with reason or logic. But that's the thing. I think that what has happened in our society is that there are certain people at the top, certain politicians and strategy setting agenda kind of people like Nancy Pelosi, maybe, and George Soros most definitely is doing this, where they have realized the irrationality paradox, that actors that take irrational actions are often rewarded for it. And they're starting to try and apply it at a high scale, right? And Republicans saw them doing this, and so Republicans, that not knowing the whole logic behind it, started to do it too, and started to have success with it as well. That essentially they approached the whole political economic system with where are some instances where I can act irrational and be rewarded for it, right? And so then it come in and YOLO into a stock that is literally going bankrupt, and you get rewarded for it, right? That's what's going on. You can be rational as an investor and say this business in reality isn't worth this much or this little, but then you can be rational another way and go, the irrational people are doing X. Well, yeah. I mean, I think that the bigger picture here is that, again, value, what a company is worth, has a tenuous connection to future orders. So your system is going to have to incorporate more than just that if you want to be successful in all environments. Clearly, though, from the value approach, from that, that field of study, Warren Buffett had a really good system that's worth studying, right? But there are things that we know. And isn't it kind of funny to sit down and say, like, we know something that Warren Buffett doesn't? Maybe he does know it, but he just doesn't think about it. But let's just say, for the sake of understanding and teaching, we know something that Warren Buffett doesn't, that we can try and incorporate, that could give us an advantage over Warren Buffett in an environment like this one. Well, the treasuries have kind of settled just below 18 here. So it kind of looks like we had the stop run. We've come back to the scene of the crime. I was really hoping that I was going to get more. I feel really dumb only taking 10 on this, but it's time for me to get out. So that's fine. It was still a good trade. And we did learn a few things there, right? Well, the price is its value to you and its value to other people, but stock prices can't be different for me and you. Stock's price can't have sentimental value to everyone. I'm not sure what you mean by that. Yeah, we did. Yeah. Because I had never thought, I mean, we haven't seen a move like this in a really long time. So I had never really watched this kind of a move with the idea of large meta orders and everything else. And I can very much see where there was a point at which the person executing this backed off because it was going too fast. But then everybody else kind of went and ran with it. And so when those guys went and ran with it and we got the stop run backed off, you know, it came all the way back because the meta order wasn't there to support it anymore. So next time that I see that sort of a thing, and I think that stop run is really coming, I really probably should take some profits on the stop run. Especially in a situation like today where I don't really think that it's going to be like a trend day, you know? Like, I think that they should balance out somewhere like 18 or 20 at the end of the day. I bet you that there's still going to be another leg. It's just, it's not going to be until like 9:30, 9:15, maybe 9:15. Maybe 9:15 we get another rung. And this continues to move up into the close. I think both value and order flow movement are good in a portfolio. Well, yeah, but I mean, it's from a portfolio perspective, what you're really talking about is value versus growth, right? So because Warren Buffett doesn't really have any growth in his portfolio other than Apple, he's missed out. He's underperformed this market. Like, if you have 10 apples and I have 300 oranges, my oranges aren't worth anything to me anymore above 10 oranges. So the price of an orange is based on the value to you, aka your financial position. I think that a lot of that kind of analysis, the mistake that a lot of that kind of game theory has, is that they kind of assume that price is value, you know. But because we know that the market is inefficient, we really have to take our model with that there is a price that a purely rational system, given all available information and infinite knowledge, would be able to calculate an exact price at which that asset should be at that time, and that number is almost always different from the actual price, right? And the whole problem of markets that we're trying to solve is that no one individual has the ability to calculate that true value price. And so by combining everybody's information together into a market, we should be able to arrive at that price. And the efficient market hypothesis was the hypothesis that actually we do arrive at that price. But what we've learned is that that's not true. Why? Because my balance sheet is different to yours. Yeah. But yeah, so then when so then once you understand that the market's not efficient, then we kind of have to come in and we have to say, like a better approach of trying to predict future price movement is, you know, Stickball has 300 oranges. And he doesn't really need oranges anymore, so he's going to move that into other assets. And what are the other assets that he's going to move them into, and what is the deal? Well, Maybe Stickball is managing a fund, and that fund requires him to have 30% of his portfolio into apples. And so now he has to sell, now he has to sell 90 oranges into the market in order to maintain his required allocation, right? Or we could say he's a retail investor. What are the sorts of things that he's likely to put his money into? And so then I'm going to go and look at what stocks are the popular, what are the ones that are getting the most social media attention, and that he's the most likely going to see, because most retail traders aren't going to go and dig and find like these stocks that nobody's ever heard of. They're going to look at like the most popular stocks and pick one of those, right? And we can use that sort of a thing to predict future price if we know that he has too many oranges. And this is predicting future price movement based on the idea that orders move markets. You know what? It was really on this trade. It was the 30-year that killed us, right? I got in. Oh, okay. Never mind. We're fine. Didn't really move much more. I thought that we had moved down a little bit more, and I thought, I gotta, because when I had $20, I was like, or 30, even every step of the way. I do this, right? I've let them come back on me before, because this is the hard thing. But I think we learned something really important about it. The hard thing is like sometimes it goes and it just goes and it goes and it goes and it goes and it goes. And sometimes it comes all the way back. And I think that the thing that we learned today is that we can look at the order flow and we can actually make a determination that this amount of it was a large meta order buying, but at this point they backed off and this was a stop run. The meta order could still be out there. But when we saw things die out there at 21, we should have taken sequential profits at the very least. So good. And we still made money. It's okay. Actually, we're doing really good, actually. And let me come in here. Let's go look at one of the things that's kind of been irking me. It's like when we were having these arguments earlier in the week with some people, it was like, okay, so then, prove it. Like, because what they want is they want me to say, well, I've become a millionaire from trading my strategy, so you should. And I'm never going to see that, even if I haven't made $1 million. I made $50, right? But you know what? That's wrong. This is wrong. We only want to see the 10-year trades. That one includes some stuff from other things. Okay, yes, we made $16. Hey, that's not bad. That was just this week, though. It was just this week. And that was after a loss over here. But we've dug ourselves out of that hole. That's good. And hey, we got pretty good volatility today. I'm not so sure that tomorrow's going to be good. What do we have the news tomorrow? We do have something tomorrow, don't we? Oh, no, we don't. We don't have any Friday news today, this week. We do have some Fed speakers, so we could still have some volatility, although that's 8:45. That's pretty late in the session. Okay, so probably we don't do too much tomorrow, but we could get some good trades next week because of options and all of that nonsense. So in terms of the S&P 500, even though we had like a really doozy of a down move, a lot of people were getting protection. So there's actually still a really good chance that they buy this dip and we're fine. At least into Friday. I think that on Monday there's probably going to be a little bit of chaos, right? So that's where we're at. But the whole point of the exercise is how do you convince people to trade rationally? If we were to come in and say, well, I made a ton of money, you should try and doing it too, That would be an irrational. That wouldn't be convincing them rationally. So it would defeat the purpose of the exercise. The exercise is how do you make rationality appealing to people? That's the challenge. Okay. I will see you guys tomorrow. Stay profitable, friends.